Hi Akash. So today I just want to take you to few equity related discussion. Investors are really frustrated with the near to zero returns. Post COVID, there is a surge in profit. Later on, it was slowed down completely. So, which sectors might do good after this 2026 till 2030? So, what's your view on this?
So thank you for having me here, and I appreciate you inviting me to discuss this with your audience. So you rightly said that a lot of sectors did phenomenally well
Yes.
after COVID. 2020 markets rebounded very sharply.
Mhm.
Then 2021 to 2024-25, over a period of 3 to 5 years, we saw very high earnings growth across corporate India, right? Which was not there prior to that.
Yes.
In the period of 2010 to 2020, that full decade, earnings growth for corporate India, BSE 500 pool of companies, was a tepid low to mid single digit.
Yeah.
However, that's revived significantly after COVID. We saw large caps, mid caps, small caps all deliver 15 to 20% earnings compounding, and markets responded to that earnings compounding, right?
Yes.
Mid cap index went up 23-24% CAGR last 5 years. So did small caps. Even large cap indices delivered healthy double digits, right?
Yes.
And earnings was very broad based across multiple sectors, be it financials, PSU banks, which did not have any earnings growth profile prior to COVID, had this new lease of life because NPAs went down, plummeted from a peak of almost 9%. NPAs are hardly there right now. So earnings growth profile across PSUs, across private sector banks, NBFCs, capital market ecosystem, that full ecosystem has emerged only in the last 7-8 years. Financials is a very large proportion of our equity market. About 35% of the entire market cap resides in more or less financials, right?
Yes.
So we saw broad-based earnings recovery. Then we had sectors linked to investment-linked sectors, right? Capital goods, defense, roads, railways, manufacturing ecosystem across multiple subsectors. Everything did phenomenally well, right?
Yes.
Even pharma, consumer discretionary, there was revenge buying. If you remember, 2022-23, you went to an airport or went to a 5-star, you didn't have a place to sit, right? That's how packed airports were. So people were traveling, left, right, and center. Malls were packed. E-commerce wave was going on. So across different sectors, we had pretty high earnings growth.
Okay.
Right now, over the last year and a half, earnings growth has been a bit patchy. Right.
Okay.
The reason for that has been corporate India has slowed down.
Okay.
Right. Corporate India growth is a function of what is the growth rate for the economy. Our economic growth was fairly high until 2024.
Okay.
And then there was a phase of the last 5 to 6 quarters where GDP growth slowed down. Latest quarter GDP growth had been about 8.5, 8.6% from the peak of about 12% which we delivered in 2024 in nominal terms.
Yes.
Right? So real GDP has slowed down. Even inflation has come off, right? We are at record low inflation today. So that has had a repercussion on nominal growth. And nominal growth is important because companies' top lines is a function of what nominal growth is. So nominal growth slowed down, because of which you had slowdown in growth across large cap, mid cap, small cap cohort of companies, right? And multiple sectors also slowed down. Interestingly, we are seeing in the last 3 to 6 months, earnings growth is reviving. India was undergoing a cyclical slowdown. That itself is reviving. Right? The outlook for GDP growth for next financial year and the next 2-3 years combined is in the vicinity of 10 to 11%. From a low of 8.5%, GDP growth will revive by about 2.5 to 3%. Our long-term trajectory has been in the vicinity of 11 to 12% GDP growth, real being around 6.5 to 7%. Plus, you add close to 4.5% inflation, which has normally been there in the country. We are at record low, but I don't think it will continue to be so low in years to come. You would typically have that. As GDP growth revives, a lot of companies who are operating within the domestic economy, their growth rates should come back.
Okay.
Right? So that is the basic premise.
Okay. So do you think this is because of the tariff impact that we are facing right now? What of the situation with almost near to zero returns, whatever the investors are facing? Is that because of the tariff related issues or because of this low inflation issues?
So like last year and a half, returns have been very tepid because of multiple reasons. One was, look, India is a growth economy. Anybody who's investing in India is investing for higher earnings growth, higher GDP growth trajectory. And we are one of the few economies where the long-term outlook is fairly good.
Okay.
No other country is growing at the pace we are growing. However, in the last 5-6 quarters, there has been a perceptible slowdown in earnings growth.
Okay.
We've been used to seeing healthy double-digit earnings growth after COVID, but last 5-6 quarters, corporate India has grown at sub 10% on an average, right?
Okay.
Which is picking up now for the latest quarter. But at an aggregate level, you had low earnings growth. That was the first reason.
Okay.
The second reason, if you recollect, early last year, 2025, we had major geopolitical issues within our country, right? India-Pakistan issue flared up and literally became a full-blown war, right? We had this Operation Sindoor, which took place. So that is a very big negative event.
Okay.
After probably the Kargil war in 1999, we've not had such a confrontation with our neighbor. So that was taken quite negatively by foreign institutional investors. And then you had these tariff issues, right? And US economy went to trade wars with almost every country in the world, but India got singled out eventually. Right? We were perceived to be a friendly country to the US. However, on the tariff side, we ended up getting the highest tariff. Right? At 50% tariff, we were even higher than China. Right? Where initially people were expecting China would get the wrong end of the stick, but India ended up getting 50% tariff. So because of that, sentiments of foreign institutional investors in our country turned severely negative.
Okay.
Right? To that extent that 2025 calendar year had the highest FIIs selling ever in India.
Yes.
The FII selling was of the order of 18 to 19 billion dollars.
Okay.
And specifically after the second reciprocal tariff that came on our country, I think in the first week of August, the FII selling from then until last month was about 12 to 13 billion dollars.
Okay.
Right? Such a high amount of selling in such a short span of time has never happened. Right? Look what's been happening across the world. Most global markets were hitting new highs. Right? Even low growth markets such as Japan, South Korea, UK, Italy ended up doing multiple times of our return. Why did that happen? Capital went elsewhere. Those markets were cheap. Those markets were delivering earnings growth. And India got singled out as the anti-AI trade. For the last 3 years, there's been a massive global mega trend across AI and AI related ecosystem. Right? We've seen between 2023 to now, the kind of capex that has been going across the world is humongous. The world has not seen this kind of capex. Right? To give some perspective, 2026 alone, the top 7 companies, the top 7 tech companies in the US called the Magnificent 7 companies, they are investing something of the order of $650 billion in AI related capex. Which is up threefold over the last 4 years. In the last 1 year alone, that would have been up 50 to 60%. India's capex budget for the central government is $180 billion, about 12 lakh crores, right? Which is up like a healthy double digit. But corporate India does maybe something of the order of $150 billion of capex. So the Magnificent 7 companies put together are investing about $650 billion in AI related investments across. Because of that, 2023, 2024, the returns in NASDAQ and specifically the Magnificent 7 pool of companies was fairly high. Right? The earnings growth is of the order of 30 to 40, 50% in some cases, consistently for the last couple of years. Right? So earnings growth was high. They ended up delivering fantastic returns. Then in 2025, the AI investment and the AI flow of capital went across the world to countries like South Korea. Last year, 2025, South Korea delivered about 80% dollar returns, right? Unheard of returns. Japan was up multifold as compared to India. So was UK, where there is no AI related trade, but however, it was up because it's cheap market and earnings growth is okay. So various countries did phenomenally well. India's relative underperformance to global markets and specifically global emerging markets was at a 30-year low. Right? So this is the worst underperformance India has had related to global emerging markets in the last 30 years. Right?
That's the last 1 year. The last 1 year time frame.
The last 1 year return right, is the worst. Indian markets were up by and large, let's say Nifty 50. Nifty was up 10%. Right? Foreign institutional investors specifically, they made 10% in rupee terms, but they lost 5 to 6% on the dollar because of the dollar depreciation. So they look at dollar returns. The dollar returns made in India versus other emerging markets, the difference of the two was the highest and the worst in the last 30 years. So India underperformed so much.
So because of valuation issue or the geopolitical issues?
So look, India has had growth phases in the past also, where we've grown fast and then we've had a lull phase and then we've again done okay. By and large, we've done okay as a country, right, over the last 15, 20 years. And stock market returns have reflected longer term earnings growth profile of companies and the economy. So this is not new that India is undergoing a slowdown, right? But this time around, what was new is India being singled out by US. Sentiment soared significantly because of the US tariff issues. And also, the world had a reasonably good alternative to go to, which was AI-related investments. Right? You do not move out completely of one asset class or one country just because temporary returns are not so good. You need to have another asset class where you can make meaningfully high returns for you to sell India. So FIs have sold India to that extent that today FI positioning in India is at a 15-year low.
Oh,
Right?
okay.
And we think India's relative valuation vis-a-vis other global emerging markets is today at a 10-year mean. Right? A year and a half, 2 years back, it was at a significantly higher valuation.
Okay.
But today we are at a 10-year average valuation versus other markets.
Okay.
Right? The earnings growth profile that is projected over the next 2 to 3 years in India is early double digits to mid double digits.
Okay.
Right? For corporate India. Right? Which is also the case for most other markets today. Right?
Okay.
Where global investors have options to invest. So valuations have corrected. Right? Earnings growth is picking up.
Okay.
And is looking good for the next 2-3 years.
Okay.
So I think the reasons to sell India that were there a year back, a lot of the reasons are getting corrected. So sentiments are reviving. Of late, we've seen in the last couple of weeks, massive trade deals have happened. The India-EU trade deal, the mother of all trade deals, which took 22 years to happen.
Yes.
I mean, India will get hopefully a lot of access to FDI flows over the next couple of years.
Yeah.
Things don't turn on a dime, right? It takes time for these things to materialize, but these are massive events.
Yeah.
Just following that, we had the India and US trade deal. From being the worst country on paper in terms of tariff, today, after that, we were the fourth best country in terms of at least tariff. As things stands today, everybody has a 15% tariff, right?
Yes.
So there's a level playing field actually. India is not singled out. So sentiments have recovered. There was massive FI selling in the last couple of months. We've seen in the month of Feb, FI selling has become a net buying number.
Okay.
Albeit a small number, which is north of 1,000 crores as we stand. But nevertheless, the selling has at least stopped.
Okay.
Right? So that's a good outcome to have.
Okay. So at this situation, your trust is coming up with a mid-cap fund. So don't you think this is the period where even investors might feel riskier investing in a mid-cap fund? So what do you see so special with the mid-cap segment?
So there is as of today, the way things stand across mid-cap, small-cap, people have become frustrated, I think, right?
Yes,
because the last 12 to 18 months, a lot of investors who came in are seeing muted returns. In some cases, SIP returns could be 0 to slightly negative depending upon at what time frame you invested.
Yes.
So it's understandable. We need to educate investors, younger investors who've come in the market in the last 3-5 years, that returns are not linear. Markets don't make returns for you every year.
That's
right. They move in phases. Companies' profits, economy moves at a linear pace, right?
Okay.
But markets will have a sine wave, up and down. They keep having like a cardiogram. But at least the good thing for India is that up and down movement happens at a 25-30 degree gradient. Because for the last 15-20 years, markets have given healthy double-digit CAGR. So please remember, between 2020 to 2024, markets went up a lot. Mid and small cap indices specifically gave returns of the order of mid-20s. Right? 24-25% CAGR was made.
Yes.
If you look at the history of the last 35-40 years of Sensex or even Nifty, right, there have been phases when market goes up, a 3 to 5 year phase, and then you'll have a consolidation or sideways movement of 1.5 year.
Yes, true.
Coincidentally, that's been the case in the last 30 odd years in India. And coincidentally, as we stand, the last 1.5 years has seen a time-wise, a price-wise correction. Valuations have corrected relative to the last 5 years average. Specifically for mid-caps, what we've seen is that earnings growth for corporate India has been more or less lackluster over the last year and a half. However, mid-caps actually outshines. Earnings growth over the last couple of quarters has consistently been in the 20% plus vicinity.
Okay.
And mid-caps is the only part of the segment where earnings growth has got revised upwards because of better performance as compared to what people were initially anticipating. So I think that itself is a pretty good reason for people to start looking at that asset class.
Okay.
Now, it doesn't mean you will make money in their asset class, right? You have to pay reasonable valuations for that.
Yes.
So as of today, mid-cap index valuations are at about 27p 1 year forward. The same multiple was 35-36p back in September 24.
Yes.
Valuations have corrected by 25%. Earnings growth outlook is improving over the last couple of quarters. For the next 2 years, mid-cap has earnings growth outlook of the order of 21-22% CAGR. Large caps is in early double digits to late single digits. Small caps is between 18 to 20%. So mid-caps provide to investors today with the highest earnings growth trajectory, and the growth is coming here and now also. So these aren't very lofty assumptions to start with. Valuations have corrected. Today valuations are at a mean of the last 5-6 years, right?
Yes.
So I think this is a good time for somebody who wants to come in, look at this asset class and invest from a 3 to 5 year time horizon.
Okay.
Last 5 years, we made 24-25% CAGR in mid-cap index, point to point. Do not assume you'll get 24-25% return,
Okay.
right? That kind of return is abnormally high. Right? Come in with a modest expectation. Typically, large caps compound at 10 to 12%,
Yes.
right, over the longer run.
Yes.
You can expect 3 to 4% higher compounding in mid caps if your time horizon is between 3 to 5 years, right?
Yes.
So that is the level of compounding one can anticipate.
Yes.
Right?
So even the last year you have come up with a small cap fund. So I
Right.
was surprised. I don't know why Trust came with a small cap when there is a complete downturn in particular the small cap segment. But surprisingly, your fund was outstanding. So
Thank
what
you.
is the philosophy the Trust follow to keep the funds outstanding?
So we came with a small cap fund in end of November 2024. That's when we launched. And
Almost it's the peak of the market, I guess.
yeah, in hindsight, when you look at it, it was the peak of the market, you could say, because markets peaked out in by and large between September to December, right? So at the time, small caps for 2024 had delivered, I think the index had delivered 27% return. That was on the back of 2023 being again very high returns. So there were 2 years of phenomenal return backed by solid earnings.
Yes.
And for the first time after COVID, we were seeing a lot of sectors, a lot of companies emerge where these guys were not there. These companies were not there in a meaningful manner prior to COVID.
Okay.
For a very long period prior to COVID, approximately 7 to 8 years, small cap earnings went nowhere. And we saw that earnings picked up, balance sheet quality of companies picked up meaningfully. The return on equity, the quality of the businesses is materially different. We have a new wave of promoters, new sectors have emerged in our country, which are primarily in the small cap phase. So we said the small cap is a stock pickers market, right? If you look at the universe about 2,000 crores, there are, I think, of the 700 to 800 companies,
Yes.
right? If my memory serves me right. We need to make a portfolio of 50, 60 stocks where earnings growth is of the order of 25-30%, hopefully. We said there is enough that we can identify, right? And we don't target annual returns, but I think so far in the last 15-16 months that we have launched the fund, the outcomes have been quite good.
Okay.
Right? Sheer stock picking, where what we do is we look at earnings growth of companies.
Okay.
Earnings growth of companies where there is a mega trend underway.
Mhm.
Right? We are not interested in just the next 2 quarters or the next 1 year or the next 1 or 2 years. Typically, you end up making good amount of money in the stock market where there is a tailwind for multiple years. Right?
Yes.
So the runway of growth is very important, right?
Yes.
And for the runway of growth, you require large opportunity size. If the opportunity size itself is limited, you'll have a moderate runway and then it will fizzle out. So a lot of sectors, a lot of mega trends are underway in our country, thankfully, right? At our economy size, at our GDP per capita of close to $3,000, there are multiple things which have actually played out in the world the last 25-30 years, which are playing out in India today. So you need to focus on those mega trends, identify the top couple of companies within each mega trend, within each subsector, and back entrepreneurs who are delivering relentless execution. So growth at reasonable valuation is what we look at. Primarily, that's what our investing mantra is.
So the time you came up with a small cap, definitely the entire PE of small cap segment was very high.
Right.
By looking at your PEG ratio, it was very decent.
Right.
Practically speaking.
Right.
So how do you manage that?
The small cap universe is so large that looking at the PE of the entire universe sometimes can be meaningless. It can misguide investors, right?
Yes.
Even if you look at the small cap 250 index, it's an index of 250 companies. We have to focus on the 40, 50, 60 companies where we need to focus our energies on, right?
Okay.
So we've, over the last 15, 16 months that we've been doing small cap, our portfolios are delivering earnings growth of the order of 35 to 40%.
Yeah.
Right? As of today, the earnings growth is around mid-30s, but we've seen very high earnings growth over the last year and a half for our portfolio of companies.
Okay.
Right? And this is not on a quarterly basis. This is, we look at earnings growth over the next 2 year, rolling 2 year basis, right? So companies will change in the portfolio. Sectors might change a little bit, but as long as you can have a pool of companies where earnings growth is fairly high, today we are lucky to have these kind of high earnings growth, right?
Yeah.
Maybe 2 years out, it might be higher or lower. Time will tell.
Yes.
But the idea is, if you look at the index, right, the small cap 250 index, the earnings growth, the outlook is about 18 to 20%. We're able to devise a portfolio where earnings growth is almost twice of the underlying index.
True.
To pay for higher growth, you have to pay up a slightly higher premium multiple. We look at a PEG ratio.
Yes.
Where today the index PEG ratio is at a certain level. Our PEG ratios consistently have been hovering between 1 to 1.2. the index P ratio is significantly higher as compared to ours.
Yeah.
So we believe that if we are able to achieve these outcomes over long periods of time, over 3, 5, 6 years, investors would end up getting reasonable returns.
Okay. So I just want to understand. So the trust as an AMC may be new to the people. So what is the history of the trust?
So trust is new, and over the last 5, 6 years, we've seen so many new AMCs
Yes.
come about in the Indian market because financialization of savings as a wave has picked up meaningfully in the last 5 years and will continue to do so. Trust actually started off way back in early 2000s,
Yes.
2001, 2002 was when Trust Capital started off. Our promoter is Mr. Utpal Seth and his wife Neepa Seth. His wife Neepa Seth is the managing director and she's a rank holding chartered accountant. So Trust Capital is primarily known as one of the top few non-bank debt capital market
Yes.
brokers in the country.
True,
And
yes.
consistently for the last decade or so, we've been actually the top non-bank debt capital market
Okay.
broker in the country. So that's a pretty solid business which has been on for the last 2 decades plus. Over the years, Trust has gravitated into multiple other B2B businesses. The mutual fund foray was started off in 2019. That's when we got a mutual fund license.
Okay.
And for the first couple of years, Trust did only debt schemes.
Yes.
Right? Because our mainstay was debt, Trust Capital's mainstay.
Yes.
So they started off with debt, and it was only in 2024 when the team got formed, early part of 2024, we started off our first equity offering.
Yes.
So Trust has been around for a long time. Our promoters have been doing this. Mr. Utpal Seth, who's the board member, advisor, mentor to the mutual fund business, has been an equity stalwart for the last 35, 40 years. He spent most of his career
Yes.
alongside Mr. Rakesh Jhunjhunwala
Yes.
as CEO and senior partner, managing his family office, Rare Enterprises.
Yes.
So that is about his background. Right? There are very few equity market investors who have seen that kind of wealth creation that the kind that Rare Enterprises did in the
Yes.
last 25, 30 years.
Yes.
So we are using some of his learnings, right? The kind of investing framework, the philosophy that they adopted.
Yes.
We're using that. Something called as terminal value investing that
Yes,
he has propagated over the last many years very effectively, which is what they've even practiced at Rare Enterprises, and he also in his personal investing journey,
Okay.
which is to look beyond the initial 2-3 years.
Yeah.
To make big money in the stock market,
Yeah.
you need to have a private equity mindset.
Yes.
Right?
True.
What will work in the next 5, 10, 15 years?
Yes.
The kind of questions you start to ask yourself when you have a 5, 10 year, 15 year horizon are very different from what you would ask from an investment which is evaluated from the next 1 to 2 year perspective.
Yes.
Right?
Yes.
So I think this is what we can bring different to the table. Have that sort of a mindset in a select cohort of companies, and you can't do that in the large companies because everybody knows about these companies. Some of the younger companies, the smaller cap companies, which are more undiscovered, where people don't have conviction on the opportunity size, on the promoter's capability, on what exactly is the competitive differentiation. That's the most exciting part.
Okay.
Because if you get that right,
Yes.
your compounding journey can be non-linear.
Yes. Yes. True. So when it comes to sector specific, so if I ask you to tell us 3 sectors that might ride next to bull run, maybe
Right.
for 2026, 2030.
Right.
So what's your pick?
The next 4 to 5 years, hard to assume which will be the top sector.
Yeah.
But I'll tell you where we are deployed our capital, right? So
Yes.
we've got about 3,000 crores of equity assets across the 3 schemes we are running. The most overweight position for us over the last year or so has been financials. And within financials, we have taken exposure across various subsectors. So let's look at financials. You've got large banks, private sector, public sector, and you've got the mid-sized banks.
Okay.
What's been doing very well within the country over the last 2-3 years is the mid-sized banks,
Yes.
where loan growth profile, earnings growth profile is significantly superior to the
Yes.
larger. Right? They're taking away market share in select segments. So we've taken decent exposure to the mid-sized banks.
Okay.
Right? Also the PSU pack.
Okay.
Right? Specifically 1 or 2 companies we've seen on the PSU pack where earnings growth, top line growth has been significantly higher vis-a-vis their own history.
Okay.
Right? Because the issues of the past are no longer there. And also they are taking away market share from the private sector banks.
Okay.
Right? Consistently over the last 2 years, we've seen that. So that's where we've placed our bets on the banking side. And obviously we've got the large private sector banks as well. But we've been underweight that positioning. Then we've got NBFCs, select cohort of NBFCs around vehicle finance, around consumer lending, right, who are doing well. They've been doing well over the last 2-3 years, and I think they will continue to do well over the next couple of years. Right, balance sheets are clean. Loan growth is coming back in many of these companies because the end market outlook is quite good. Then you've got the capital market ecosystem, which is where we've been quite bullish. You've got stock exchanges, commodity exchanges,
Yes.
where earnings growth profile is going up non-linearly in the last few years. Right? You had companies like BSC, MCX, which have done remarkably well. Thankfully, we've taken part. The entire AMC ecosystem, right, which got listed in the last 7-8 years. You've seen the kind of money flow that is coming into the equity
Yes.
market. AMCs are a big beneficiary. So we've been bullish on that full ecosystem. Right?
Okay.
So financials form a big overweight positioning, and I think they will continue to be a mainstay in our portfolios.
Okay.
Second, interestingly, is the entire infrastructure, make in India, industrialization kind of theme, which is captured in capital goods and industrials, where you've got multiple subsectors. First of all, it started off prior to COVID, where we said, look, we need to become Atmanirbhar, there needs to be more make in India.
Yes.
Government has done a lot of policy framework to incentivize capital investments into India over the last many years. It got stalled during COVID, obviously, but I think it'll restart now with the trade deals being there.
Yeah.
In that, we have seen sectors like electronic manufacturing, chemical manufacturing, auto ancillaries, defense manufacturing, where a lot of things were imported earlier, and today India is becoming self-sufficient, right?
Yes.
And a lot of capex, anyways, organically is happening in these sectors because India is underinvested in some of these. We were heavily import reliant in many of these sectors, and now there's the import substitution that's happening. Either there is a China plus one theme underway, or there is a Europe plus one theme underway in various subsectors, right?
Yes.
And many subsectors will join this party, I think, in the next 4 to 5 years as these trade deals fructify and come into play.
Okay.
Right? So that's the second theme. The third is consumption.
Okay.
Right? And within consumption, we have premium consumption,
Okay.
which is actually a pretty big theme.
Okay.
Right? We've seen in most countries over the last 25, 30 years, as the GDP per capita goes up, right, the kind of consumption spend that the person has or the family has, that changes dramatically.
Okay.
Right? Initially, with basic income, you end up spending 40-50% of your household income on food, right? Roti kapda makan, we would say.
Yes.
But as your income doubles, trebles, right, and quadruples, you realize discretionary consumption, going out, spending on yourself, experiences, right, spending on better clothes, or vacationing out of the country, spending on premium vehicles, that becomes a mainstay.
Yes.
In the last 7-8 years, we have seen premium consumption hit a J curve. Right? So that is a big theme, and that will continue to be a big theme in years to come, in probably the next 10-15 years, I would say, and beyond, because our GDP per capita is significantly low today. Right? As it goes from $3,000 to $8,000 to $10,000 in years to come, you will get to see non-linearity in premium consumption across multiple subcategories.
Okay.
I would say these are the 3 sub-themes, and within that, there are various subsectors to play.
Yes. So, summarizing it, it is BFSI, infra, and you are focusing on
BFSI, capital goods.
Capital goods.
Yeah, that makes up various subsectors actually, and capital goods / manufacturing, I would say.
Yeah.
And consumption within that, premium consumption.
Premium consumption you are focusing on.
Yeah, there are multiple others, but since you asked me 3, I give you 3.
I understood. So when it comes to IT in specific, so it is almost, I think, till yesterday, I think it's almost 35% down from its peak.
Yeah.
IT. So seriously, will this AI will disturb Indian IT sector, because it is one of the good contributor to the GDP till now. It is not just a GDP contributor, even the employment generated and that employee spending on this in this country. So IT is playing a really significant role in this country. So what will be the impact on Indian IT sector going further?
So unfortunately, I don't have a clear answer, right? Because the world is evolving so quickly. On a week-to-week basis, we are getting to see new information flow. Now, AI has been around for a couple of years, right? But only in the last 1 to 2 months, we've seen the kind of disruption that some of these large LLM companies, be it Claude, Anthropic, or ChatGPT, they're making big impact on enterprise software, right? That's the reason why IT is correcting over the last month or so in India. Now, there are 2 schools of thought. One is that AI will unleash productivity gains so much that you won't require so many employees to do that kind of labor. Right? In the last 25-30 years, when IT services industry started off in India, earlier it was initially labor arbitrage. But as time progressed, we realized that labor arbitrage was not the only reason for world to come to India for offshoring. Right? Indian companies have become domain experts. They become consulting experts within their domain. Right? So over the years, labor arbitrage has not been the only reason. right?
Okay.
Because some other company would figure out a cheaper way to do it, or some other country, but that's not been the case. We've gravitated towards delivering solutions, right? Towards consulting, implementation.
Mhm.
So today, the thought process is that AI will disrupt business models of IT companies.
Yes.
The business model of IT companies is what? You charge per hour
Yes.
into number of people you can deploy,
headcount.
right? Into the headcount. By and large, that is principally the business model. Fixed price nature of business, and there is a time and material. By and large, there is a time and material aspect to it. Now, if Anthropic and some of these guys come and say that earlier it would take you 1,000 people to write code and do a particular project over 6 months, now it can be done by a handful of people over a couple of days, or in some cases hours.
Yes.
Right? So you may not require, the business models will change. The kind of pricing that you could command earlier will not be the same going into the future. So there could be a massive deflation, right, in pricing of these companies.
Yes.
So that is one school of thought. How will these companies evolve? Whereas the IT companies, right, the IT services companies, what they are saying is that, look, if the world truly needs to move to AI and large enterprises need to adopt AI, they will need to cleanse their data, right? A lot of code over the last 30, 40 years has been written in different languages, resides in different mainframes, and those mainframes are coded something in COBOL, something in some other language, right? So to truly reflect the benefits of AI, cleanse the data, and then take it up and then put an AI layer over it, right?
Okay.
Now, large multi-billion-dollar, multi-country operations, banks, or large manufacturing conglomerates, they will not rely on internal companies or internal AI teams to do this. The IT services companies do this for you over the last 25, 30 years. They understand your business, your code much better than anybody else. There is nobody else competent enough to gravitate them from traditional business model to the AI ready business model.
Yeah.
So there could be a new opportunity size opening up for some of these companies, right?
Okay.
That is there. But will you require so many people to do that?
That
Maybe
was
not.
the question. Yeah.
You may use AI and deliver that opportunity size in much lesser time frame at a much lower pricing, right? So we don't know which way it's headed, honestly, right now.
Okay.
My personal view is that the market could have overreacted. Could have, right? Typically, when stocks correct 30, 40, 50%, and large sectors, large companies, people start to question their terminal growth rates, right? Nothing is going to change in the interim, right? Over the next 1, 2, 3 years, maybe growth profiles continue to be what they were supposed to be, right? Which is of the order of 5, 6%. Most of these companies, specifically the large cap IT companies, were low growth to begin with.
Yeah.
People who were anticipating maybe until a year back that terminal growth rates would be of the order of 5, 6%, right? Now, if growth rate assumptions get recalibrated downwards to even 2, 3%, you end up having big impact on stock prices. Because the terminal growth rate, the terminal value of these companies is about 60 to 80% of the current market price.
Okay.
So if you reduce that by 1%, you could have 15 to 20% correction. You reduce it by 2%, right? On different companies, different margin profile, you have different kind of impact. People are recalibrating long-term growth assumptions for IT sector.
Okay.
Which is what happened in the last month. I'm not sure how to react. For the last couple of months, we've had underweight positioning.
Okay.
We've been bullish on the mid-cap cohort of the market. Right?
Okay.
We think the growth rates are much higher as compared to at least the large cap.
Okay.
So, we'll see it as it comes. The world is evolving. Every week there's a new announcement. Right?
Yes.
So we truly don't know what will be the longer term impact. We'll wait and watch.
Okay.
Stock prices have corrected, but doesn't mean we want to be bottom fishing. We'll see how the sector evolves. We'll see how companies will resort to this AI threat.
Okay.
A lot of companies are doing something or the other. They recognize right, that the world is changing. A lot of the IT companies are tying up with some of these AI companies.
Yes.
They are providing an application layer, or at least they're trying to do something. Right? So it's not necessary that growth rates will get ruptured. We've seen in the last 25, 30 years, a lot has happened in the world. Technology has evolved. Business models have evolved. IT companies have kept up pace.
Yes.
Just in the last 10 years, we saw between the phase of 2016 to 2019, when cloud adoption was coming about, right? When you had large tech companies in the US doing their cloud data servers and all of that, people said the world has to move to cloud. How will, old IT companies sort of adopt and move? So there was a big question mark on their growth profile.
Yes.
For a reasonable amount of period, IT did not do anything, did not deliver good returns, and IT was ignored, and valuations became quite attractive.
Yes.
Right? But doesn't mean you start to invest right away. If the moment you get to see growth reviving, right, So in this scenario also, when we see growth reviving, when we see outlook increasing, or at least not going down, because people are expecting that there will be a deflation impact on their business model. Same thing happened in 2016 to 19 when growth outlook improved,
Yes.
and it improved significantly.
Yes.
You got to see IT stocks bounce back.
They have done much better after that.
Yes, 2021 actually IT was the best performing index, and
Yes.
many stocks have gone on to deliver multi-bagger returns from the COVID lows.
Yes.
So you cannot write off this sector. Today, Indian IT services ecosystem has a market share of between 20-25% in the global IT spends. So you cannot write off this
Okay.
sector. I think you've got a very smart bunch of people working in this sector, and I think they will evolve.
Yes.
They will figure it out. But this is a transition phase.
Transition phase. This is not the end. This is just.
This is
transition
definitely
phase.
not the end. I would not write it off.
Okay.
As an investor, I would watch it very closely, and once I see signs of things improving, I would probably take that kind of
So
action.
do you have allocation in IT?
Yes, we do have.
Okay.
We are not zero on IT. We have had lower allocations relative to what the benchmark is, relative to some of our peers have. In some of our portfolios, like small cap, our IT allocations are significantly low, non-existent.
Okay.
But in the other portfolios, the IT allocations are there, significantly lower than what we used to have a couple of months back.
So IT from the large cap or the emerging ITs? What are you carrying?
So the kind of exposure we've held traditionally is more of the mid-cap IT.
Mid-cap IT.
Yeah.
Okay.
See, at Trust, what excites us is growth outlook. The first thing that we look at in a company is what is the growth and what is the longevity of the growth, right? And the second thing we ask is what is the valuation I want to pay for that, right?
Yes.
Because not necessarily every growth profile will end up making money, right? If the growth itself is low, right? Large cap IT, like I said, grows at mid-single digit. If they end up growing fast, they'll grow at high single digit, which is 7 to 9%. To expect anything beyond that is very tough because global IT services spends grows at low single digit, right? It's a function of global GDP. So that kind of growth profile doesn't excite us, honestly. We've got enough and more available in the mid and small cap space. And why does one need to be invested only in IT? You could get 25-30% earnings growth profile in so many other sectors, right? So I think our capital is better utilized over there. Okay. That's what we've done over the last 12 odd months. But now, given the kind of price disruption that has happened, we will definitely watch this space closely.
Okay.
Right? Because there could be value emerging or there could not be, depending upon which way we figure out the wind is blowing.
Okay. So AI is not just about the IT industry.
Right.
AI is for everyone now.
That's correct.
How AI is going to change the landscape of mutual fund investing?
So thankfully, I can tell you about ourselves,
Yeah.
right? And then probably extend that thought to the mutual fund industry. Over the last 1 year at Trust AMC, we've adopted AI, right?
Okay.
So we've got ChatGPT across all of our analysts, and ChatGPT has become our 7th analyst probably, right?
Oh.
ChatGPT, Notebook LM, right? Perplexity. So mixture of all these things we are using. So far, the biggest use case for us is to analyze raw data in the shortest possible time. I'll give you some examples. Analyzing con calls of companies, right? Over a period of 2, 3, 4 years, what have they said? What have been the top 10 most important things discussed in the last 1 year? What have been the questions that investors have asked them? What has been the tone of the management, right? What was the guidance earlier? What has actually transpired in the subsequent 2, 3, 4 quarters? These are the kind of things that we are using.
LM is doing that.
Exactly. Earlier, one would have to read like pages and pages. It would take probably 45 minutes to an hour to read 2, 3 con calls. Now that happens within a minute or two, right? And gives you a nice cleansed tabular format of what is happening. So that is one use case, and there are multiple more, right?
Okay.
The world has become so integrated. As an Indian equity investor, I need to also track what's happening in China, what's happening in Korea, what's happening in the US, so across the world, to analyze what companies are saying, what investments they are making, which subsectors they are more bullish on, bearish on, what will be the repercussion on Indian companies within those sectors, right?
Yes.
So you could do all of these cross linkages today very easily.
Okay.
Provided you know where to look, right? And
true.
AI will look it up for you, and do that kind of sort of analysis. So I think that is the number one use case for us, and among many other things. I think the similar kind of use cases are being done by the mutual fund industry.
Okay.
And people are sort of trying to curate the LLM models as per how they deem best fit, right? So the more you train it, the better the outcomes become in times to come.
It's all about how you are going to train it.
Exactly.
That's true. I understand. So the entire industry is going to change their landscape, operating landscape with AI going further.
Well, industry has started off in the last couple of quarters. I'm seeing across my peers use more of AI as compared to what it used to be in 2024. Let's see how it evolves. Definitely, there is more of AI happening.
I understood. So one last question. Actually, I can say an input or a suggestion as a fund manager. So people invest in mutual funds. So, but you are the fund manager. So as a fund manager, you want to say one word to the investors. So what is that?
Well, look, mutual fund is a great vehicle,
Hmm.
right? The kind of compounding that the industry has delivered over the last 5, 10, 15, 20, 25 years is phenomenal. There are a lot of fund managers who've gone on to deliver 18, 20% compounding over a 20-year time frame.
Hmm.
The unfortunate part is that people who delivered that kind of compounding, go and ask those AMCs how many investors stayed the course. People don't stay the course.
Yeah, true.
So people have not compounded at the rate that the fund's NAV has compounded.
Yes.
There is a big gap between the investment return and the investor return,
Yes.
right? And a lot of people have done this analysis, and the difference is between 3 to 5%. So it is very important for investors to stay the course through ups and downs. Equity is a volatile asset class. It's like a cardiogram.
Yes.
Right? People react to greed and fear. People react to emotions, right?
Yes.
Something is going wrong, stocks go down, right?
Yes.
But the earnings growth of that company or the earnings does not move. But your sentiment towards that news impacts how you will do with that stock.
True.
Right? So sentiments determine what you will do. You look at fixed assets, right? People invest in real estate for the last 30, 40 years. You don't ask the price of your house every day, every month, every year, right? It's invested for years together, in some cases invested for the next generation. Why can't you have a similar outlook in equity? Right? You need to change that mindset, right? And a lot of education work, and thanks to you and your channel, a lot of education work is being done over the last couple of years, where people are becoming more longer term in nature. Right? It's a business investment. When you invest in a business, you would not think for the next 1 day, 2 days, 3 days, right? Why can't you think in multiples of years, right? Multi-decade investments. And truly, only 1 to 2% of investors are able to think like that.
True.
And compound generational wealth.
Yes.
Right. So I think as more and more people understand how this asset class behaves, they will be able to take true benefits of it.
Yeah. Thank you. And thank you so much, Aakash. And thanks for your insights. And very soon again we will meet and we will give most possible knowledge that we can do to that. Thank you very much.
Thank you so much for having me. I appreciate it.